Thank you very much for your kind introduction. Thank you, Pablo, for the invitation and chance to be here. Good morning to everyone. And let me also welcome Ambassador Reynosa. It's a pleasure to meet you and be here with you today in beautiful Madrid. So today I will briefly discuss the current economic situation and the stresses that emerged in the U.S. banking system earlier this year. I'll have some brief remarks and then we'll sit down and have our conversation. I will then turn to the evolution of the financial system since the Great Recession and conclude with a few general observations. And I'll highlight how global efforts to boost resilience in the financial sector over the past decade have been an important success. I'll also discuss how recent developments have revealed residual vulnerabilities that we are going to address and the need to be vigilant for emerging risks. U.S. economic growth slowed significantly last year, and recent indicators suggest that economic activity has continued to expand in the U.S. at a modest pace. Growth in consumer spending has picked up this year, and some indicators in the housing market have turned up recently. At the same time, activity in the housing market sector remains far below its peak in early 2022, reflecting the effects of higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. The U.S. labor market remains very tight. Over the past 3 months, payroll job gains have been robust. The unemployment rate has moved up but remains historically low. There are some signs that supply and demand in the labor market are coming into better balance, including higher labor force participation, some easing in nominal wage growth, and declining vacancies. While the jobs to workers gap has declined, labor demand still substantially exceeds the supply of available workers. Inflation, however, remains well above our longer-run goal of 2%. Over the 12 months ending in May, total personal consumption expenditure prices are estimated to have risen 3.9%. Excluding the volatile food and energy categories, core PCE prices appear to have risen 4.7%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. Since early last year, we have raised our policy rate by 5 percentage points. That's 500 basis points. We see the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, especially housing and investment. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. The economy is also facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. Tighter credit conditions are a natural result of tighter monetary policy, but the bank stresses that emerged in March may well lead to a further tightening in credit conditions, and the extent of these effects remains uncertain. At our last meeting, the Federal Open Market Committee decided to maintain the target range for the federal funds rate at 5 to 5.25%, while continuing the process of significantly reducing our securities holdings. We made this decision in light of the distance we've come in tightening policy, the uncertain lags in monetary policy, and the potential headwinds from credit tightening. As noted in the FOMC's Summary of Economic Projections, a strong majority of committee participants expect that it will be appropriate to raise interest rates 2 or more times by the end of this year. When bank stress emerged in March, we acted in concert with other U.S. government agencies to address it, enabling the Federal Deposit Insurance Corporation to resolve 2 failed banks in a manner that protected all depositors. We also used our liquidity tools to make funding available to banks that might need it. In addition to our discount window, we established a new facility under our emergency lending authorities called the Bank Term Funding Program. Our provision of liquidity through these tools supported the stability of the financial system without restricting the use of our monetary policy tools to firm the stance of policy as part of our efforts to reduce inflation. The banking system remains sound and resilient, deposit flows have stabilized, and strains have eased. A little more than a decade ago, the global financial crisis required extraordinary interventions by governments around the world. Stabilizing the U.S. financial system required coordinated efforts by all parts of the government, including $700 billion in taxpayer funds to recapitalize banks, a suite of Fed emergency liquidity facilities, as well as government guarantees on bank transactions accounts and money market mutual funds. Despite these efforts, the Great Recession brought misery to countless millions. As the crisis slowly receded, authorities in the U.S. and around the world implemented a host of reforms. The goal was to build a system that could withstand severe shocks, including unanticipated ones that might arrive from any direction. In other words, a financial system that would be a source of strength during stressful periods. A key pillar was building resilience in the banking system, and this effort was remarkably successful. Over the course of a decade, capital and liquidity at the largest U.S. banks more than doubled. We began a program of rigorous annual stress tests to ensure that the banking system was capitalized against severe recessions and financial market turmoil. The Great Recession also underscored the critical importance of the non-bank sector. Here, too, the authorities have undertaken a number of steps to build resilience, although much remains to be done. In 2020, the financial system was again tested, facing a truly unprecedented shock as the pandemic brought the global economy to a standstill. Investors scrambled for safety and liquidity during what we call the dash for cash. Financial markets came again under extreme pressure. Ultimately, the authorities had to support financial markets again as part of the extremely forceful monetary and fiscal response to the public health emergency. The banking system, however, was now far more resilient than it had been before the reforms, and thus well positioned to absorb the shock. We cannot take the resilience of the financial system for granted, however. The multiple shocks we've seen over the past year or so, including the extreme volatility in commodity markets following Russia's invasion of Ukraine, and of course, surprisingly high and persistent inflation, as well as the associated increases in interest rates, stressed a large range of bank and non-bank financial institutions. Given the efforts to build resilience in the banking system over the past decade and a half, two natural questions might ask are, first, why did Silicon Valley Bank and two other sizable U.S. banks fail this spring? And second, why did Credit Suisse, a globally systemically important bank, or GSIB, require a government-supported rescue acquisition? We are committed to learning the lessons from the U.S. bank failures for our program of supervision and regulation, and I'll offer three brief observations about these events. The first observation is that it is very difficult to resist the natural human tendency to want to fight the last war, as we say. In 2008, we saw banks come under stress from outsized credit losses and insufficient liquidity. Such losses appeared possible in the early days of the pandemic crisis, although they ultimately did not materialize. In our stress tests, we have considered severe stress scenarios that produced losses on banks' books, including outsized credit losses. But of course, Silicon Valley Bank's vulnerability came not from credit risk, but from excessive interest rate risk exposure and a business model that was vulnerable in ways its management did not fully appreciate, including a heavy reliance on uninsured deposits. These events suggest a need to strengthen our supervision and regulation of institutions that are the size of Silicon Valley Bank. I look forward to evaluating proposals for such changes and implementing them where appropriate. Much will depend on getting the specifics right, and we should bear in mind that there are always trade-offs with any financial regulation. In addition, the U.S. has benefited from its rich, multi-tiered banking ecosystem, and that diversity should be preserved. The second observation I'll make is the value of forthrightly recognizing when a crisis is building and responding decisively. When SVB failed, it was clear that a number of standard assumptions, even though they were informed by hard experience and historical data, were wrong. Notably, bank runs were no longer a matter of days or weeks. They could now be nearly instantaneous. Fortunately, in concert with other parts of our government, we were able to act decisively to meet liquidity needs of the banking system, protect depositors, and ultimately limit contagion. The third observation I'll make is the value of having the very large banks be highly resilient. Our regulatory system is much stronger for the substantial additional safeguards we've built around the GSIBs since the Great Recession. They are subject to capital surcharges, required to be highly liquid, and held to the highest supervisory standards. The events of the past couple of months would have been much more difficult to manage had the largest banks been undercapitalized or illiquid. The Great Recession was certainly a watershed moment, demonstrating the terrible consequences a fragile financial system can have on people's lives. In response, regulators in the U.S. and around the globe set out to build a much more resilient financial system. And the ensuing experiences of the pandemic in the past few months did much to validate this approach. The bank runs and the failures of 2023, however, were painful reminders that we cannot predict all of the stresses that will inevitably come with time and chance. We therefore must not grow complacent about the financial system's resilience. And building and maintaining this resilience requires collaboration. The system was able to withstand recent shocks because of the efforts by regulators and legislators, including our international counterparts in the globally interconnected financial system. So we'll take these lessons on board, we'll keep learning, because the work of building and maintaining a resilient financial system is never done. Thanks.
Thank you very much, Chair Powell, for these very interesting remarks. And I'm very pleased to host this dialogue between Governor Hernández de Cruz and Chair Powell on financial stability issues that we see now in light of the financial sector turbulences that we witnessed earlier this year. So, Chair Powell, you outlined what has happened in the financial sector earlier this year and also the actions that the authorities took. Do you think we are done now with the financial turmoil, or do you expect more to come?
So, I guess the question is the crisis over? I would say, remember that our jobs generally involve worrying about things. That's what we do. We try to look at things, and so we're very reluctant to reach a judgment like that. So earlier this year, we had 3 significant bank failures in the United States, and we saw a real threat to contagion. We took strong actions to protect all of the depositors in every case. Of course, we're still monitoring that situation very carefully. I will say, though, deposit flows have stabilized. Things have really settled down quite a bit. Capital and liquidity in the banking system remain strong. Aggregate bank lending is actually moving up again. Banking sector profits are strong. So overall, I would say our banking system is strong and resilient. Although, again, we're carefully monitoring things.
Thanks very much. Governor, how about European banks? I thought we got away with a scare after also the Credit Suisse episode. How would you judge the situation?
Yeah. No, thank you, Cornelia. And before entering into the question, let me thank Chair Powell for coming to Madrid. It's a real pleasure. Also, thank you to all participants in this conference, and by the way, mainly to my staff for organizing, and the staff of CEMFI for organizing this conference. Well, you know, Cornelia, that from the very beginning we've been emphasizing at the European level that our banks are resilient, and this remains the case. But perhaps more than emphasizing that they are resilient, I think it's more important to put the emphasis on the reasons why this is the case. And there are at least 2-3 reasons that I wanted to put on top today. The first one is regulation. It's not an exception. Europe is not an exception in the fact that we've been implementing the Basel III reforms during the last 10 years, and this has led clearly to higher capital and liquidity ratios for our banks. Perhaps the novelty in our case is the fact that we are implementing all these rules to all banks independently of their size, meaning that the capital and liquidity requirements are applied to all banks. And this has been, in particular in the current context on which there were some small banks who were affected, has been particularly relevant also in the perception of the banks of our banking system. Second element that I want to emphasize is supervision. And it's very well in advance in the cycle when we started to increase rates, when we started to withdraw liquidity, that the SSM and the supervisory mechanism, the European supervisory mechanism, started also to put the emphasis on monitoring the risk of the banks that are more related precisely to this type of macro environment. And in particular, I think Chair Andrea Enria has been emphasizing that the emphasis was put, for example, on monitoring the liquidity funding of our banks, on monitoring interest rate risk. Many banks were asked to be more prudent in many dimensions, in the calibration of their models, in the validation of their models. And I think this has also helped to our banks to be in a more resilient position now. Then there is a third issue that perhaps also should be emphasized. It is more related to some idiosyncrasies of our banks. And the fact that, of course, I mean, the banking sector in Europe is very complex because we have many banks. But there is a good number of them that are very much focused on retail banking. And of course, this has an implication in terms, for example, for the funding and the stability of the funding. So retail deposits with a very significant amount of funding that is secure, but the deposit scheme, this has provided also for more stability. And of course, this stability of the liability side of the bank has also incorporated also some stability on the asset side of the bank, and this is also crucial. And the reality is that, for example, if you look at the Spanish banking system, the profitability has increased in a very significant manner. It's for the first time in 2022, the profitability of our bank is higher than the cost of capital. And this is mainly because they have profited for the interest rate increases that we've done at the European Central Bank. The interest rate margin has increased, meaning that the repricing of the asset side of the balance sheet has been higher than the one on the liability side. Having said that, as Chair Powell was emphasizing, this is about risk. And we know that the risks are very significant, that uncertainty is very high in the horizon, that, for example, the level of the interest margins of our banks that they have today won't be maintained, that there will be an update of the funding cost at some point, that also credit risk will increase, that there are losses that will emerge also in terms of the securities portfolios. And this is why we are emphasizing at the European level, also at the Spanish level, that we have to take the opportunity of this high profitability that we are observing in the short run to at least to keep resilience of the banks, if not even to increase resilience of our banks.
You speak to my heart as I'm responsible for macroprudential policies, so thanks very much. Governor, so just earlier this week, the European authorities in Brussels, they decided on a further update on the Basel III regulation, implementation. Are you happy with the progress that has been made?
Cornelia, can I ask you to turn the volume up a little? I'm having a hard time hearing both of you clearly.
I was just asking whether the political compromise that had been found earlier this week in the European authorities for Basel III implementation.
So Jay, is the same question that you were making to me in my room just 1 hour ago. Well, I mean, as chair of the Basel Committee, I have to be very prudent because, as you perfectly know, Cornelia, you're a member of the Basel Committee. We have a process on which we analyze and we evaluate all the details in this case of the new directive. But let me just give some very general remarks on my perception of the agreement. So, in general terms, I think the agreement fulfills the agreement that was. And that was approved in 2017 at the global level. But it is true that there are deviations. For example, in terms of the implementation of the output floor, which perhaps is the most important of the elements of the agreement in 2017 at the Basel table. What it is important in this regard is that these deviations remain purely temporal. Because we know, and there is a very good paper, by the way, published by the European Central Bank 2 years ago, that all the benefits of the Basel Agreement, the 2017 Basel Agreement, will only be perceived in terms of higher financial stability, meaning also higher growth in the medium and long run, if there is a full implementation of the agreement. And that's for me the key now, that the deviations that we know that they are there are kept purely temporal.
Thank you very much. So after the turbulence, all of us, I think, have been thinking hard whether, how to evaluate the turmoil that happened earlier this year, what lessons should be drawn. Chair Powell, what are, in your view, the main lessons that can be drawn from the turmoil from your perspective?
So, Cornelia, you're correct. We have spent a great deal of time since March thinking about that very question, as you know. And I would say to start specifically with so three institutions failed, and they were fairly idiosyncratic business models, but they shared two common characteristics. One is very poor interest rate risk management, and the other is a funding model that involved quite large amounts of uninsured deposits. So in the near term, of course, we supervise many institutions, and we're in contact with institutions that share those characteristics, and we're working with them on improving their interest rate risk management and their funding model. That's obvious, and we're doing that. More sort of medium and longer term, though, I think, and we at the Fed think that there will be ways that kind of some obvious and some less than obvious ways that we need to strengthen both regulation and supervision. I would say from a regulatory standpoint, the regulatory tools we have around liquidity, the net stable funding ratio and the liquidity coverage ratio, they embed certain assumptions about what a bank run looks like. And what a bank run used to look like was more people standing in line at an ATM, a modern bank run. That's very different from what we saw at Silicon Valley Bank, where it wasn't about ATMs, it was about people on their phones who were very technologically enabled and able to move money very quickly. So the run was much faster than anything, and that needs to be reflected in our regulation as well as our supervision. And there will be other areas where we're within the regulatory world. It's not just a supervisory issue. It is, however, to a significant degree, supervision. So the supervisors, and let me just say at the beginning, the Board of Governors controls supervision. The reserve banks implement supervision, but we said at the Board of, so we're ultimately responsible for supervision of the banks. We delegate that function to the individual 12 reserve banks. So don't read this as really ultimately the board is the one that's accountable for this. But the supervisors were on the right issues. They actually found the liquidity issues and the interest rate risk management issues, but they were operating under a standard playbook where you escalate things fairly carefully, fairly slowly. So I think we look at that and we say we need to be more agile, and where appropriate, we need to be more forceful. So we are doing, under the leadership of my colleague Michael Barr, who's the Vice Chair for Supervision, we're doing a review of our supervisory practices to try to find ways, and we will find ways to be more agile and, where appropriate, more forceful. And that's broadly where I think we are.
Thank you. I must say the Barr report is excellent reading also, so I really recommend it. So everyone is looking now to the Basel Committee, no? What do we learn in terms of regulation for the global financial sector? With your head of the chair of that committee, how would you see which lessons can be drawn from the global perspective?
Yeah, well, of course, I'm not in a position to give a very definite answer because, as you know, Cornelia, we are in the process of reviewing. There was a request by the GHOS, and we have started the work, but of course we haven't finished it. But perhaps let me try to anticipate some of the elements that for me are relevant and very much along the lines that Chair Powell was also emphasizing. The first issue is, okay, we are perhaps jumping too quickly on the regulatory issues, while I think, and this is also the consensus around the table, that perhaps we have to put more emphasis on supervision and strong supervision. Many of the elements that were behind the failures in the US and in Switzerland, and this has already been accepted by the authorities, is that supervision was not working well, okay? Well, when we've been analyzing this at the Basel Committee, the reality is that it's not only about the willingness of the supervisors to have a strong supervision, but also that it is difficult in very different dimensions. And let me perhaps put the emphasis on one of them. We know how important it is nowadays for supervisors to analyze and to have a deep understanding of the sustainability of the business models of the banks. But this is very difficult. In the end, what we are asking supervisors is whether a concrete bank will succeed in the medium and long run. when, of course, they are subjected, as many other companies, not only in the financial sector, but also in the non-financial sector, to many structural changes that are very difficult to identify for the private sector itself, and of course, even more the case for the public sector. So to have a holistic view on how to measure, how to analyze the sustainability of the business models of the banks is absolutely crucial, but it's not easy. But then even let's imagine that we are in a position to say that certain bank, the sustainability of its business model is not sustainable. Then we have to intervene. But you have to intervene in a way that you cannot be shown as co-owning the bank. So it's forcing the bank to move in one direction, but without participating in the decisions. And when we've been looking at this into the details of different jurisdictions, the reality is that the tools, the instruments that the institutions have, the authorities, the supervisors have, are very heterogeneous. And in many dimensions, in many countries, are not sufficient in order to force the banks to move in the direction we want. So I think I will put the focus on this, because I think, and it's very much related also to the strategy review that we did at the Basel Committee 3 years ago, on which, well, the final conclusion of this strategy was, okay, we've been devoting the last 20, 30 years on putting the emphasis on capital regulation and liquidity regulation and banking regulation in general, while maybe the improvements in trying to homogenize supervision across jurisdictions, the emphasis has not been sufficient. No? So that's, for me, perhaps the first conclusion. Which, of course, doesn't mean that in terms of banking regulation, we should not also learn something from these events. And here, maybe I should differentiate two things. I mean, some elements, for example, and for me the most obvious one is interest rate risk. On interest rate risk, probably there is not much, there is nothing new there. I remember the discussions that were had at the Basel Committee for many years in 2016, for example, when the consultation paper on the interest rate risk was launched. Well, the initial proposal was for having a Pillar 1 capital requirement on interest rate risk. In the end, it didn't fly, for very good reasons. I'm not questioning the final outcome. But okay, let's come back to that discussion and whether recent events should modify or not this assessment that was done at that time. And there are other issues which are, to me, new. And this is more related, for example, to liquidity. And what we've learned, for example, from the Silicon Valley Bank is that the speed of the outflow of deposits. And I have to confess that I don't have a clear idea on how to solve this problem. No? And very extreme positions on one side or the other on how to solve this problem can also create collateral damage. You know? So I think we have to be careful also before dropping into clear and definite conclusions on this.
I think some of the banks that were in trouble, they had quite good liquidity coverage ratios, for instance, so it's maybe not the right measure to look at, or at least not only to focus on that one, yes. And you mentioned interest rate risks, and you talked about stress tests. I think in our wildest scenarios that we would have designed 2 years ago, we would not have thought, we would never have modeled the rapid rise in interest rates that we have now witnessed. So it's also a tricky business. So it means also that I think we are still, the financial stability reports of our respective institutions, they still stress that we are in a situation of elevated risks, financial stability risks. So I would like to hear from you, what do you think are the main risks for your respective jurisdictions at this point in time? Chair, if you want to start.
Sure, I'd be glad to. So I guess, as you will, well, both of you will know very well, we have a framework for financial stability assessment, which we didn't have really before the global financial crisis. And we think it's helpful to have a framework that you constantly go back to, and so you can be held accountable. And it's very transparent to the public, and we talk about it. And we publish a financial stability report, I guess, semi-annually. So. The four things, four broad categories of things that we look at are, first, asset prices, secondly, borrowing by households and businesses, thirdly, leverage in the banking system, and fourth, or in the financial system, and fourth, funding risk. So the kind of things that happen with the money market funds and things like that. So we look at those, and we look at them all the time, so that we check ourselves that we're looking at everything and not just the obvious things. And and we published our most recent report in May. It's available on our website. And I would say overall, you see sort of moderate levels of vulnerability as you go through this. But there's some areas of real focus. I mentioned one of them, which is the aftermath of what we saw in the spring. That was 3 substantial banks failed unexpectedly, and we had to resort to extraordinary actions to protect depositors. We're still very carefully monitoring the banking system, although, as I pointed out, deposit flows have settled down and things have settled down broadly there. But nonetheless, it's an area of real focus. I would also point to commercial real estate as an area where there's quite a bit of focus, and that's essentially a valuation question, and it's not exclusively, but I guess mainly about office. So work from home has really changed the story for many office properties, particularly in metropolitan areas where people can work from home and they have the kinds of jobs where you can do that. And so there's a valuation adjustment going on. We know where those risks are, but by and large, they're not particularly present or concentrated in the large banks. If you go to the smaller banks, let's say in the United States, under 100 billion, there's a substantial amount of commercial real estate, but there are not too many institutions that have high concentrations. So the point is, where an institution has a high concentration of commercial real estate, whether it's office or the sort of related retail that goes with downtown offices, we have a supervisory playbook, and the supervisors are working with those institutions to address the concentration and help them work their way through it. So this is a process that's been underway for some time. We're monitoring it carefully. On things like bank capital, I would say, is widely acknowledged to be strong. That's not an issue. Bank funding is the amount of liquidity that banks now have is certainly the largest banks have is very, very high. So we still have some funding vulnerabilities, though, as we saw in March, but also we haven't really addressed the issues with money market funds yet, where there were runs in the global financial crisis. The government had to step in, and again had to step in as part of the pandemic response. There are proposals to continue to work and to diminish and hopefully solve that problem. So those are some of the things I would point to.
Thank you. And in particular, we have witnessed some inflows into money market funds now in the US, haven't we, after the turmoil?
Yes, so that was really a function of, there were some big flows that happened around the time of the March crisis, and those have stopped. There's an ongoing thing. During any tightening cycle in the United States, and I imagine elsewhere, people tend to move money over time from bank deposits into money market funds, because during a tightening cycle, there are higher yields to be had in the markets than there are in deposits. This is something that goes on, and it's just part of the process of what happens during tightening, and it causes banks to tighten lending conditions, and of course that's a desired result. And as long as that's an orderly process, it's expected as part of what we do. So there are different things going on, and I would say what we're seeing now is very much in line with expectations.
Thank you. Governor, how about the European risk?
Yeah, well, you know, Cornelia, that in the European case, the heterogeneity across countries is very high. So I will refer mainly to Spain. And here, the main element of differentiation of Spain as compared to other countries is of the euro area is that in terms of financial stability risk, the developments in the last 10 years have been relatively good, in the sense that there has been a significant leveraging process of the private sector with a significant fall of private debt to GDP ratio of our economy. The transformation of very significant current account deficit into a current account surplus, a current account surplus that has been maintained also in the last year under very stressed conditions during the pandemic and now with the energy crisis. So let's put it this way, most of the risks that we are observing and that we are emphasizing in our financial stability report are not so much endogenous, to the financial cycle itself, but more of a macro nature, and the interconnection, of course, of this with the situation of households, of firms, and also in particular, in our case, of the public sector. So, for example, if you read our last financial stability report, the one that was published in May, there was a positive statement in the sense that it is true that our economy has behaved has remained more resilient than we were initially expecting. And this has been seen, for example, in the fact that our last two projections, the projections that were published in March, the one that we've just published a few days ago, we've revised significantly, I would say, growth for this year upwards. And of course, this is good for the economy, and this is good for financial stability. But at the same time, and coming back to a comment that I made at the beginning, that uncertainty is very high, risks remain. Most of them come from geopolitical dimension, and in particular the war in Ukraine. But also very much related to the uncertainty that we have on the need and the magnitude of the monetary policy tightening that we will have to deliver in order to meet our 2% price stability mandate. And if you take this risk and you combine them with some of the vulnerabilities of the Spanish economy, I would say that the two main risks that we are facing, one is more related to the public sector. So the Spanish economy increased the public to GDP ratio in a very significant manner, more than 80 percentage points of GDP since 2007. To a certain extent, there was a transformation of the private sector debt into public sector debt. And it's not only about the stock, it's also about the flow. Structural deficit, public structural deficit in our economy is very high, around 4% according to many of the estimates that are available. And of course, this is a vulnerability of the economy, and this is a vulnerability of the economy, in particular in a context on which interest rates are increasing. No? And of course, also for the private sector, and in particular in a context on which interest rates are increasing, and at the same time inflation has remained very, very high. The combination of these two things is leading, of course, to real incomes that are falling, and of course to interest burden that is increasing. No? So, and we develop regularly, and we publish it in our financial stability report, this simulation exercise on which we see that even under the current assumptions for the expectations of interest rate increases and in our central scenario for macro growth, there will be an increase in the vulnerability and the percentage of vulnerable firms, financial vulnerable firms and financial vulnerable households. And this, of course, will have also an implication in terms of potential losses for our banks. No? So given that these are the two main risks that we are observing, this is why the policy message that we are sending is also very clear in both dimensions. So the first one I was already mentioning, the fact that we think that our banks, even if they are profiting in the very short run from the current environment, since risks remain and remain elevated, I think it's important that they keep resilient, or even that they increase the resilience in the current context. And the second is, of course, for the public sector, that we think with the current macro conditions is of the essence that a fiscal consolidation process is initiated in order to reduce in a gradual manner this vulnerability that the Spanish economy has.
So Chair Powell had mentioned the commercial real estate sector. I mean, they were, of course, very much badly hit by the COVID situation, but also residential real estate will be affected a lot by the rising interest rate environment. How's the situation in Spain?
Well, in Spain, this has also behaved relatively different to other countries. Of course, one of the main reasons of why the global financial crisis hit the Spanish economy so significantly was because of the booming of the construction sector before the global financial crisis. The adjustment has been huge. It's not only about the numbers I was giving before on private debt to GDP ratios, but also, for example, the weight of the construction sector in the economy. The construction sector reached a peak in terms of the value added of the economy. It was close to 12% before the global financial crisis. Now it's 5%, which is the average in the euro area economies. Then housing prices, housing transactions during the last year, I mean, there's been a recovery, of course, of the housing sector, but nothing compared to what we've observed in other countries like the Netherlands, Germany, and some of the Nordic countries. No? And of course, we want to think that, of course, the fact that we haven't seen exuberance in the housing market, at least as comparable to other European countries, this will also have an effect in terms of the potential adjustment in a context of higher interest rates.
Thank you. So moving on to monetary policy related aspects, or rather the interaction between monetary and financial stability, we have seen that the actions of some central banks, and not only in the US but also in the UK, for instance, last fall, central banks had to take some actions that were by some perceived as interfering with the monetary policy stance. So how would you assess, to both of you, the relationship between financial stability and price stability in your jurisdiction, Chair Powell?
So I guess I would start by saying that I see the two as tightly and closely related. We actually say in our constitutional document that the FOMC adopts every year that achieving our statutory goals of maximum employment and price stability depends on a stable financial system. So, and to think of it the other way, if there's an event, a sustained event of significant financial instability, that's certain to have, almost certain to have significant macroeconomic consequences. So the two over time, they go together. You can't really have them pointing in different directions for a sustained period of time. So that's my overall view. And I think if you look back at what we've seen, we've been able to raise interest rates and to expect further interest rates. We've been able to continue our fight to get inflation under control. At the same time, we've used our tools to foster financial stability and protect depositors and provide liquidity to institutions that may need it. We've been able to use those tools separately. I don't argue for a full and complete conceptual or practical separation between the tools. I do think the tools that foster macroeconomic stability also foster financial stability and vice versa. So I think we are accountable for both financial stability and macroeconomic stability, and our tools will broadly foster both of those outcomes. So, and I would say today our banking system is certainly strong and resilient, and interest rate risk we talked about. Most banks manage interest rate risk successfully. And I would say, I would also point out, I was going to mention that actually a very severe downturn in commercial real estate was one of the features of the stress test that we did, that we announced the results yesterday, and the 23 banks that took the stress test this year all passed that.
That's very encouraging to hear. How about you, Governor?
Yeah, well, my position is not very different to the one that has been expressed by Chair Powell. And you know, Cornelia, that we devoted a lot of time, and you were part of that team, in the strategy review that was developed by the European Central Bank and that reached to the conclusion that we published in June 2021. We were analyzing, among many other things, precisely the interconnection between financial stability and monetary policy. And in the end, we made this statement that price stability is a precondition for financial stability, and financial stability is a precondition for price stability, which in the end is showing also the important interconnections and interdependencies that we have among these two objectives. As Chair Powell was saying, I mean, in many contexts, what you do with monetary policy is absolutely compatible, and there are no trade-offs in terms of guaranteeing also financial stability. And by the way, this is not only in normal circumstances, which of course even there is even easier, because you have macro-potential tools on the one hand and the monetary tools on the other. But even in stress conditions, and you may remember, for example, at the beginning of the pandemic, the pandemic purchase program that we launched at the European Central Bank. Of course, the focus and the main objective and the main motivation of the package was to try to fight against a deflationary shock. But at the same time, the way it was designed, it made also it possible to fight against potential financial stability disturbances, in particular financial fragmentation. So using the same tool, a monetary policy tool, in the end was compatible with trying to reach both objectives. And the same is true, for example, with the TPI, the transmission protection instrument that we decided to launch in July 2022, which in the end, of course, was also trying to guarantee that the transmission of our monetary policy to the euro area was completely homogeneous. So this was a monetary policy objective. But at the same time, we know that in a context of higher interest rates, if this fragmentation issues emerge, they might also lead to financial instability. So that, again, one instrument was able do the job for trying to pursue both objectives. As Chair Powell was saying, I mean, of course you can imagine situations, and in particular in systemic crisis, that there might be a trade-off, but I would try to avoid to try to anticipate what we will do in that situation. Of course, we will have to be pragmatic in those situations and trying to anticipate well in advance those actions, including by the way the action of fiscal policy. Because if we are talking about solvency issues and not only liquidity issues, then fiscal policy will also have to play a role. I think it doesn't make much sense. So let's be pragmatic.
Very good. So going forward, of course, on the monetary policy side, we still see elevated inflation, and in particular, the core inflation is still showing quite some resistance, I think, on both sides of the Atlantic, even though energy prices have been falling over the past half year or so. So, but still, in light of the current situation, how would you expect that monetary policy might evolve over the next quarters? I'm not asking for specific predictions, but also in light of the turbulences, of course, that we have seen.
I'm tempted to say it depends, but it will depend on the evolution of the economy, which is always uncertain, and I think today particularly uncertain, given, for one thing, we raised our policy rate 5 percentage points, 500 basis points in a little bit more than a year. And most of those hikes took place in the later part of last year. So, and also policy's only been restrictive for a few months, really, for 6 or 9 months. So we're still waiting for the real effects of our tightening policy to be felt, not just on interest-sensitive spending, but more broadly throughout the economy, on activity, and then ultimately on inflation. So we believe there's some in the pipeline, as we say, and it's hard to say exactly with what speed it will come. But that's one thing that we think about a lot. It's how far we've come, and it's also how much is in the pipeline. And also, we're looking, as I mentioned, there's a macroeconomic connection with the financial issues that we saw earlier this year. There's good research showing that when banks experience stress, they tend to pull back from lending for obvious reasons. They're going to want to conserve capital and liquidity and that kind of thing. We don't see an incremental pullback yet, but we may see that, and so we're definitely thinking about that. In terms of where we are, we've said that we will use our tools to achieve a stance of policy that is sufficiently restrictive to bring inflation down to 2% over time. At our last meeting, we decided to maintain the level of rates that we are at, which is just over 5%. But at the same time indicate with our individual summaries of our individual projections for the 18 members of the FOMC, indicated that a strong majority feels that 2 or more hikes will be appropriate by the end of this year, as I mentioned during my remarks. But I would stress, though, that our commitment isn't to a particular number of rate hikes. It is to a stance of policy that's sufficiently restrictive to bring inflation down to 2%. That we can do, and that we will do. And the timing and extent of any further rate increases, of course, will depend on the course of the economy.
Thank you. And do you, so now you have just paused, and you said that you're waiting for the effects to feed through the economy, which can take quite some time. So are you worried that maybe you could overdo the tightening?
So I think as we've moved along, the risks, at the beginning there was little risk of overdoing it and a lot of risk of underdoing it. As you get closer and closer to what you think your destination is, those risks begin to come more into balance. I wouldn't say they're in balance yet. So we are certainly thinking about that. I also said, the decision was basically not to move at one meeting so that we can have more information. And so in a way we're addressing, we raised it 75 basis points at 4 consecutive meetings. Then we slowed in December to a 50 basis point hike, then 3 consecutive 25 basis point hikes. So we're continually moderating the pace. And so it may be that we don't move for a meeting and then move at a meeting. Each meeting is going to be decided. We haven't taken consecutive moves off the table, but we have said that we're prepared. And we did take one meeting where we didn't move. So that's in a way a moderation of the pace. And so I would expect something like that to continue, assuming the economy evolves about as expected. which it is not. It has a tendency to do something different. We've all seen inflation be over and over again shown to be more persistent and stronger than we expected. At some point, that may change, and I think we have to be ready to follow the data and be a little patient as we let this unfold.
Yes, thank you. So yesterday at the conference in Sintra that you also attended, there was one session about uncertainty and economic forecasting. I think the consensus is really that the level of uncertainty is extremely high in current circumstances. So it's a difficult job. So how about you, Governor? How about European monetary policy looking ahead?
Well, it's not very different in terms of the main messages given by Chair Powell. No? You know that we had our meeting just some days ago. We had new projections, full of uncertainty, these projections. I remember perfectly that the staff also is always providing the centralized scenario, but also the uncertainty that the staff gives to each number, no? in the centralized scenario. And the level of uncertainty that they were showing to us was the highest in the last 2 years, which is already something. No? And this precisely this very high level of uncertainty, the one that is motivating this idea at the Governing Council of the European Central Bank that we want to be more data dependent than ever. So it's true that the new projections were showing an upward revision in core inflation, in particular for 2023 and 2024. Also, there was a slight upward revision of headline inflation for 2025. So in the end, the conclusion was that inflation would remain high for too long and that we needed more tightening, and this is why we increased rates by 25 basis points during the meeting. And to a certain extent, we have also anticipated that if the central scenario doesn't change in a material way, we will be also in a position to increase rates also in our July meeting. But that's it. I mean, for me, at least, it's very clear that the September meeting is absolutely open in terms of whether there will be or not a necessity to tighten monetary policy more. I see things now more two-sided. On the one hand, it's obvious that the fact that inflation is keeping high for too long also increases the probability of having very significant or more significant second-round effects on wages and markups, something that, of course, is not incorporated into the central scenario. And of course, if this materializes, this would lead to higher tightening needed in the future. But at the same time, I also see that monetary policy transmission is working, and is working in a very forceful way. And the fact that we are already observing some weaknesses in economic data in the euro area, I think, in my view, is also related to the fact that monetary policy tightening is already having an effect on the economy. And we know that given the size, the magnitude, and the speed of the tightening that we've done in a very short period of time, we can also miscalibrate the potential consequences of this tightening. There might be some non-linear effects. So we have to monitor both not only developments on core inflation, headline inflation, projections, but also the transmission of our monetary policy. And we have to be ready to react accordingly to what we see. No? So, I mean, very high uncertainty should lead to data dependency. So let's just not enter into discussions on what the tightening could be in the second half of the year. I think it's too early to say.
So you say that the tightening is already being felt in the economy, but on the other hand, the labor market is very strong in the euro area, I think also in the US. So will there be a bad surprise at some point in time for the working population?
Well, I mean, the transmission mechanism of monetary policy is through demand. That's obvious. There is no other way that I can think of how monetary policy can be transmitted, and lower consumption, lower investment, in the end, would also lead to lower employment. That's clear. But the good news are, of course, is that till now we are in a situation on which labor market, not only in Europe, not only in Spain, but all over the world, in the US for sure, is behaving very well. So that the initial position is also good. So that then the impact that the monetary policy might have on employment in net terms will be perhaps lower.
So I would have one very final question, and that's really looking ahead, not in the next quarters, but maybe in the longer term, because we have now seen a period, a whole decade of exceptionally low interest rates. I don't think unprecedented here. We had negative interest rates on this side of the Atlantic. So by historical standards, really something very special and a very, very accommodative monetary policy. So what is your prediction? Will we ever see a return to this very low interest rate environment, or do you think that over the long term the equilibrium will be at again a higher level?
I guess I start. Policy was accommodative. I think there was good evidence to think that the neutral rate of interest was significantly declining over a long period of time due to a lot of global forces, demographics, aging population around the world, maybe globalization, advance of technology, a lot of savings in the world, those sorts of things. So that was the world we were in until the pandemic. And now, of course, we're in a world, and that was a world of very low inflation, low growth, low productivity, and low rates. Now the pandemic comes, and it's this enormously disruptive event. The disruptions are likely to last for years on end. And the question is, where will we come out in the end? It's a really good question. I think it's very hard to know, and there are people arguing both sides. I think for the near term, central banks are going to be very sensitive about inflation. We will not assume that we're going back to that low inflation environment for a good while, because, of course, we've seen what's happened. In terms of rates, I think we're just going to have to find our way. You would have thought it wouldn't have been thinkable to have a 5% interest rate before the pandemic, and now the question is that tight enough policy? And a strong majority of almost overwhelmingly, FOMC participants think that we need to do more to get to a level of tight policy. So I don't think we have the longer run answer, but it's a good question.
No, I fully agree with Jay. I mean, for sure, in the short run, we know that rates will remain high. That's clear, under any scenario that I can envisage. Of course, the interesting question is more the long run. To what extent these things have changed? And I don't know, when I go through the list of the arguments that were used even before the pandemic to justify why R star was low, I mean, in many dimensions, I don't see material changes. So, for example, the main two arguments that were justifying very low R star estimates were, on the one hand, low productivity. And, well, I don't see a significant change in productivity dynamics across the globe. You may think that digitalization might improve productivity at some point, but at the same time, you have all this potential deglobalization process that will go in the opposite direction. It will have negative consequences on productivity. Then the second main argument that was always used was demographics. And, of course, demographics is a very slow-moving variable. It's not that it has changed or will change materially in the following years. And perhaps for me the main novelty, and even as a consequence of the pandemic and the response that was given in particular by fiscal policy, is that across the globe public debt is higher. And of course this will require higher saving in order to finance this public debt, and this could lead to also higher long-term rates. That's for me perhaps the variable that would have changed with a more medium-term perspective, or long-run perspective. But as Jerome Powell was saying, I mean, the certainty on all these non-absorbable variables is very, very significant, in particular in the current context.
Thank you very much. So bottom line, even the most experienced and distinguished central bankers don't know.
Correct.
So thank you very much. This concludes our dialogue for this morning. Thank you very much, Chair Powell, Governor Hernández. Thanks very much.
Thank you.
Thank you.